really have the time to get into it, and also was um, dealing with some personal changes. And I don't have a complete resume for him, but I will tell you that he's a CFA, Chartered Financial Analyst, FRM. I keep wanting to say Fellow of the Royal Machinery, but that's what is FRM, Rangan?
Financial risk manager.
Financial risk manager. All right. If y'all could turn your screens on, that would be really great because we started here and we would like everyone to be able to see everyone else. He has over 20 years of trading and risk management experience with the focus on energy commodities. He's traded natural gas, crude oil, refined products, and electricity for utilities, pipeline companies, major integrated oil companies, and banks and hedge funds. So he is definitely a commodities trader and he deals with physical underlyings. He graduated magna cum laude from Rice University with the BA in Econ and Managerial Studies. He got the Financial Risk Manager certificate in 1999 and the CFA in 2001. And since then, he has been making so much money that he's gotten to the point where he is telling himself, I need a life change because money is no longer a real sort of objective anymore. So we're really going to be interested to hear about that, Rangan. So maybe if we have no other questions, we could just turn it over to Rangan.
Thank you. Thank you, John.
Yes,
Can you guys see that presentation?
I see it.
Okay. So I wanted to focus on the concept of asymmetry in financial markets. It's important, I want to convey that it's important to identify and align yourself with the asymmetry in your favor, when you get involved in market endeavors. I think something about the human brain, it's not so intuitive, and that kind of leaves a lot of opportunity. Just like exponential growth isn't something that we just naturally think of. We tend to focus a little more linearly. So when you can find asymmetry or structure things to make them asymmetric, I think that's one area of the market that has a lot of opportunity. So you guys are stat 686 or whatever it is, way higher than I ever went in statistics. I'm sure you're very familiar with a standard deviation, bell curve. And the concept of heavy tails, that's just a concept of, as you know, markets tend to have heavy tails where things that are typically, in a normal distribution, you kind of think about 3 standard deviations. If you work for GE, maybe you think of 6, but, things in the markets sometimes, happen in 10 and 20 standard deviation moves. And really the lesson from that is the underlying distribution wasn't normal to begin with. So that's just a little visual there. So thinking back to the tallest man, who has ever lived, the tallest verified account is a guy named Robert Wadlow. And, he looks very mature in this picture, but he actually died at the age of 22, sadly. But if you were to take him and throw in 3,000 average people with a height of say 5'3", what would that do to the average height? And it doesn't really do a whole lot. It went up to 63.014%. 63.014 inches. And, again, height is kind of a natural phenomenon. Now, when you look at something like wealth, take Jeff Bezos, currently the richest man in the world. Actually, maybe with Tesla's move today, it's Elon Musk, but when I made this slide, it was Jeff Bezos. And, if you put him in a group of 3,000 people that have an average wealth of 350,000, what's kind of the first number that comes off the top of your head as to what the average would be?
400 maybe.
Really? So 67 million. So that's just an example of asymmetry where 3,000 people, but that 200 billion is so far on the tail that now each of these people have an average net worth of almost 67 million.
Wow.
So using heavy tails in the market. So, for example, if you were to model things under a normal curve or model things, based on a heavy tailed distribution, the Dow Jones losing 7.5% over a 3-day period, which happened in February of 2018. And it actually happens almost every year and a half. And a funny story about that one. I was actually headed to Hawaii with my girlfriend, and hadn't had a vacation in a long time, and that was a trip. And as soon as we get on the plane, I'm looking at the market open, and I'm like, oh, this is getting ugly. But of course, we take off. There's no way to connect, and we land, and maybe between airports, there's a little bit of looking at stuff, but the market was pretty much closed at that time. But when we finally get to our Airbnb, pull out my laptop, log in, and I'm working. And she was really upset. This was probably early in our relationship. She didn't really realize how much I worked, and she was literally throwing things at me because she was like, "This is vacation." And so we kind of came to a happy medium where I was waking up at 2 a.m., which Hawaii time was kind of before the market opened, work until about 10:30, which was when the market closed over there, and then we would go do our vacation stuff. And so really for my entire week, I didn't get to sleep. So it was a vacation without sleep. But you can't always dictate when the movements are going to happen. Um, and then if you look at, for example, COVID last year is a lot more fresh in our minds, but over a 1 month period, the S&P dropped 30%. And looking at a normal distribution, that would never happen. But under a heavy tail distribution, it does happen. In fact, I think I looked back and I think it was 1962 was the last time that it happened. And then, again, Black Monday, I was playing Monopoly back then. I didn't really follow the stock market. But again, something that would be inconceivable is actually possible, and something that you should, you don't want to change your entire life for it, but you have to always understand that it's possible in everything that you do. So, I think these asymmetric opportunities repeat themselves. And I believe in part they're based on human nature, which doesn't change over, all the centuries. Um, it's human nature to want to leverage the fractional reserve banking system that most of, the US and most countries are based on, is a form of leverage in and of itself. And I used to have this old boss, and he had a way of putting things real simply. And he was telling me about a friend of his that was day trading and doing really well. And he was just saying that the biggest problem people have is, they set out and set a goal for themselves. I'm going to make $1,000 a day, and they start doing it. And then pretty soon they're like, let me just 10x everything, and I'll make $10,000 a day, and then they're that logic has no limit, and they kind of essentially take it to a point where they blow themselves up. And I just think there's something in human nature, you know, not to step on any whatever. It's been a long time since I've done public speaking, so I'm not sure what the norms are anymore. But I think it is more ingrained in men than women, where I think men tend to be extremely confident, perhaps overconfident, and have these huge up cycles and then complete collapses, huge up cycles, complete crashes. In my experience, of the women that I've met in the trading world, they tend to be a little more conservative and not go through the same amplitude in those cycles. They may still have the same cycle, but just not to the same extremes. But recency bias again, right? Like right when things are going the best and everything has been straight up, and all the statistics say, oh my God, the markets go up 20% a year. Look at the last 10 years. That's kind of right when people push their confidence to the boundaries and use the most leverage. And again, I think these are some of the natural cyclical things that keep making these opportunities repeat themselves. Then the other aspect of it is, when you think about steady returns, in theory, people want steady returns. We're trained to go work for a paycheck and get a certain number of dollars every month, and spend the same amount every month, have a budget, save the same amount. And trading is not like that. At least trading in this method, where sometimes you're going to hit that home run, and then, hey, maybe that's what's going to cover you for the next 3 or 4 years. And then you're going to be scratching a lot in between. But short gamma strategies refer to the selling of options. And that becomes an attractive thing to people who are trying to get a steady amount of returns. And when you think about managed money, if you're waiting around, like let's say you have an asymmetric strategy, it's going to hit once every 3 years, but you'll make 10 years worth of money. If the first 3 years you haven't hit, all your investors would have left by now. So you kind of have this incentive to show them something, along the way, which, doesn't necessarily fit with this, this method that I think has the best potential. So again, the principal agency of that is just, if you're able to show the money up front, you tend to raise more money. Whereas if you're waiting for kind of those one-off events, which do happen, and then they pay off very huge when they do happen, if they don't happen fast enough, you lose your investor base. So anyway, George Soros had coined a term called reflexivity, where he just says that things are very rarely at fair value. They're either on a cycle from extremely undervalued to extremely over, or vice versa, and they just kind of shoot through fair value. And there's typically loops that cause these things. A great book actually on bubbles is one called The Popular Delusions and the Madness of Crowds. It was, something.
Extraordinary Popular Delusions and the Madness of Crowds.
Yeah. So in there they had a chapter on the South Sea bubble, and what I loved about that is, from what I remember, the South Sea Company got exclusive rights to do certain trading, from the British government, and that led to people wanting to be in that equity, and then the company itself, or people were allowed to borrow off that equity, and they were putting it back in that equity, and it just kind of created this positive feedback loop that took it to unsustainable levels. And when I think of that, I think of micro strategies these days. And not to say that they're involved in anything inappropriate. Like, I believe the South Sea Company eventually had bad news they weren't sharing, and various other fraudulent type things. But they put money in Bitcoin. The Bitcoin went up, which increases their value, which makes their stock go up. If their stock goes up, they can issue more debt or stock or whatever, and they can buy more Bitcoin, which makes Bitcoin go up. And you kind of have this little cycle, and now it's no longer just them. They've opened it up to a bunch of other corporations and showed them how they do it, and it's becoming a kind of a feedback loop that and those kind of things. There's no logic to saying the fair value is X or Y. They're going to go until they stop going, until the weight of of whatever's going to picking them up kind of stops, and then they usually come back just as fast. So these feedback loops, they followed by the unwind, they happen repeatedly in all kinds of time frames, in all kinds of markets. So here's just a few of my favorite books on market psychology. Reminiscence of a Stock Operator is
Great one.
phenomenal. Yeah, it's more of a story, and the lessons in here were from the 1920s, and those nuggets of wisdom are the same as they are today. They're all about human nature and psychology. Fooled by Randomness by Nassim Taleb, that is a great way to look at probability and chance. It just creates a framework. I didn't realize that, for me, this is fairly natural. I look at the risk and reward of everything that I do, whether I'm going to jaywalk or eat at a certain restaurant. I'm like, well, what's the risk that I get COVID from here? What's the risk that my stomach's upset, versus what's the pleasure I deem from eating that food. And for me, it's been very natural. And I think it was kind of a learning process for me to realize that not everyone actually thinks that way. But this book really kind of is good with that. This book here, I would say, is a little more advanced. It ties in a lot with technical analysis. And once you become very adept at that, it kind of gives you the sentiment backdrop to various patterns, various parts of the cycle. So it's kind of like an extra check mark where, maybe you have everything lined up from a technical standpoint, but the sentiment just isn't right. And, and maybe from a technical standpoint, it could be either B or D, what you're looking at. And then this kind of helps you realize, okay, it's probably D, it's not B, in terms of where you go or the pattern that's unfolding.
Wait, Rangan, could I just ask you a question about your books?
Yeah, sure.
Do you have Market Wizards anywhere in this presentation?
I do not, but I have the books.
There is a book by Jack
Schwager.
Schwager called Market Wizards and More Market Wizards, which was the second on there, maybe even the third follow-on.
So there's Market Wizards, New Market Wizards, Hedge Fund Market Wizards, and then I believe he has a new book recently. And in New Market Wizards, one of the traders he profiled is a lady by the name of Linda Bradford Rashke. And I came across her in about 2008, and I stalked everything she ever wrote and, had a bunch of thoughtful questions and approached her, and we become really good friends. She's actually invested in my last two funds, sends my kid birthday presents all the time. Great person. And she's in her 60s now. She trades for herself, but she doesn't want to manage money anymore. But, just like in any field or endeavor, which the way it used to be in our day was no one gave you anything and you weren't owed anything. You had to go out and kiss a lot of whatever to get wherever you needed to go. You needed to show value immediately to people. You didn't just walk up to someone and say, hey, teach me this, right? They're like, who are you? Well, why do I care? You walk up to them and you give them something of value, like, hey, I have these skills. I'll do this analysis for you. I'll do that for you. And that was kind of the way relationships were forged. And then you kind of find a mentor like that, if you're lucky. And she's been like a great mentor for me through a lot of the stuff. And then even just personally, through a lot of ups and downs in life outside of the markets.
Yeah, I just want to say Linda Bradford Rashke is a very well-known, if you could say famous, technical analyst and stock trader. She publishes most of all of what she does in the trade journals, and so she's very well known, and people follow her. So she's kind of like famous. So the fact that she and Rangan are hanging out together speaks very well of Rangan's trading philosophy.
Thanks.
She has a few great trades. Like she and her style and Victor Niederhofer's are like on point too.
Her and who?
Victor Niederhofer.
Oh, Niederhofer, right? Yeah. Niederhofer has caught himself on the wrong side of some of this asymmetry at times. But I knew a guy that worked for him once who really liked him, and that was actually a guy who taught me a lot about money management, the position sizing, and that would be a whole nother presentation. But that's a very important consideration, probably even more so than the trading itself.
Yeah, for y'all who don't know, I'm not going to tell you the whole story, but there's an expression in the trading world called "they pulled a Niederhofer," so that kind of tells you what happened. But he's blown up several times, and every time he comes back and puts a new fund together, it's just amazing. I'm sure he's still in the game now.
Wow. So, how do we align ourselves to capture these asymmetric returns? Certain markets just have them. Power is a market that I've traded in the past and I'm involved with again, where it just shocks me at how, when you look at the distribution of prices, you can go, typically 20, 30, 40 bucks a megawatt hour during a spike. They have to physically cap it at 9,000. So, it's a very asymmetric return. If you're long power, if you're short power, that asymmetry could work against you. Another way is through time frames. When you look at something like equities in general, over a very, very long period of time, a stock could go up 1,000%, but you never really risked more than 100%. And then you could also then start playing with the actual products and structure a product such that it has the asymmetry. Basic options like, this last bullet here, like weekly options is one, but, you can even, there's no limit to the amount of engineering that goes on between banks and funds in terms of creating very specific products. And then multiple time frame analysis. That's one that I'll spend a little bit of time on, because that's one that's kind of in your control, where you're taking a linear market, a linear product, and just trading it, creating a method by which you can create asymmetry for yourself. And then actually, I'll probably go most into this weekly options, because I had already had a presentation prepared for that 2 years ago that I gave in Vegas. So I just kind of slid that into the last example there.
So this year, that Texas ERCOT trade on power, I know people that made like $100 million over the course of a week trading that.
Yeah, that was a very I've yeah. Yeah, there are people that did really well on that, and there are a few that didn't. But the bankruptcies are not nearly as bad as were initially expected. So, but yeah, that asymmetry is especially in power. So, when you look at a physical commodity versus a financial market, you may want a Swiss franc, but if it's too expensive, you'll happily own a euro. Or if you want exposure to the S&P and it's too expensive, you'll buy the Russell, you'll buy the NASDAQ, you'll buy something else. And those kind of financial adjustments can be made with the click of a button these days. So there's nothing physically sticky causing that large, imbalance that can give you the asymmetry. But, if you're running a hospital with 1,000 COVID patients on ventilators, if you need electricity to run those ventilators, nothing else is going to do. You can't substitute electricity for anything else in that situation. So, that's kind of a difference between physical commodities and financial ones. So like, this example of a supply chain, a profit incentive, if you're making a product and 1% of the cost goes into a certain commodity, and that commodity goes up 20% in price in a week, so your cost goes from 1% to 1.2% of that particular thing. It doesn't make you change your behavior. In economics, you kind of learn, oh, well, price goes up, demand goes down. Well, it really depends. If that particular product is just one little piece of a bigger product, then it really doesn't drive your bottom line. It's going to take a much higher price increase before you actually say, hey, let me substitute that out. Let me see how I can make my product without this. And then, lead time, like, think of a copper mine or something like that, where all of a sudden, Joe Biden gets in office and says, we're going to do electric cars by whenever, and those require a lot more copper than a traditional car. Well, it still takes 10 years to get permitting and get a mine open and start digging and get to the actual copper. So over that period of time, the supply can be really tight. So it's almost like the cycles are much larger. In a financial cycle, within days you can kind of mean revert. It's just a matter of money going in or money coming out. When you have a physical need for something, there's an actual physical constraint for that being created. So like this fixed versus marginal cost, when you think of oil, and I'm grossly oversimplifying, but the marginal cost of shale oil is about $40 a barrel. But to create a new well, you've got to put in the fixed cost, the fixed capital costs, and that hurdle is closer to $60. So, if prices go below 40, people will shut off, because, on a marginal basis, why would you pay $40 to get back 35? And that'll keep your price up. And my numbers are a little old. That number's probably in the 30s now. But to actually increase supply, you would need it to go over 60 for them to say, now it's worth it for me to put up some new rigs, do all that other stuff, connect the pipelines. And, so then from OPEC standpoint, as someone that probably wants to keep shale at bay, 60 is kind of a nice level to sort of just keep it at. Don't go too far above it, kind of, adjust supply to kind of stay right within it. But again, the point is, things don't instantaneously, when you have physical considerations. And then regulation, of course, is just one that messes up a lot of things. Utilities is one of my best examples of that. Having worked at a utility, I know the mindset is, if we screw up, the ratepayer, will go to the PUC, make a case, and the cost will get passed on to the ratepayer. But that's conditional on we didn't do anything out of the ordinary. So even if we saw this power surge coming, we didn't go pre-buy this power, because then if it didn't work in our favor, they would look at you and say, hey, why did you do that? So there's kind of a very set method of behavior, which is predictable and not completely efficient. But people stick to it because by sticking to it, even if they end up spending a lot more, they have a good case to go get the rates raised. And so their isn't affected. And also utilities back in the day, I'm not sure if they still work that way. It was called a cost plus model, where whatever your costs are plus 10%, 12%, whatever your allowed rate of return is what you're allowed to charge. So you don't really have an incentive to lower your costs. I mean, you can't do ridiculous things, and you can't offer company Ferraris and whatnot. That would be obvious. But in small areas where perhaps in a more competitive company, they would eke out some efficiencies at a regulated utility, they don't really have that incentive. So again, another gross oversimplification with power. If this transmission line can carry 80 megawatts of power from where it's being generated to where it's needed, and only 50 is going, well, then the prices are going to be roughly equal. There's three components to the price, but just for this example, the prices are going to be equal. Where you'll have trouble is when more than 80 megawatts needs to go on this particular path, then you basically, the price here has to go up to the point that you destroy demand. And when you think of demand as being, residential, commercial, industrial, as a residential and commercial customer, vast majority of people have a fixed price plan. So, you don't really have an incentive to turn your lights off just because prices are going up, because your bill's not going to be, representative of that. Commercial, if you're running a Gucci store, you don't necessarily shut your Gucci store down because, 5% of your cost is electricity at the store. You keep it going. Industrials are probably the most sensitive. They probably have their calculation of, our widget, 30% of the cost of our widget is power. So if the price goes up to X, turn it off, don't make widgets right now, wait for the price to go back down. But, so kind of the structural way in which most people have fixed price power doesn't really give you an incentive to destroy demand when the price signal goes up. And by the same token, if more than 80 megawatts is supplied at this side and it can't go there, various producers will sort of be cutting each other's throats to drop price to be the power that goes across the line. And really, three different things can happen here. You could just have the load here be 110, one day just because the weather blew out. There was some crazy event. You could have this transmission line break down and maybe it only carries 40. They're half of the line, something happens, they have to send someone out to go fix it. And the same thing with generation at this side. The power itself could drop to where the load can't be satisfied, in which case, prices spike also. And so again, a lot of those things are variable, and this is a gross oversimplification, because imagine hundreds and hundreds of generation nodes, load nodes, different types of transmission lines going between places. And, and that's kind of, what happened for us. There was a combination of issues. There were certain transmission lines that went down. There was an outrageous amount of demand based on the weather, and certain generation wasn't able to come on for various reasons, whether it be wind for, having frozen down, or some of the gas plants that there's gas supply wasn't coming in. So it was a perfect storm where all three things happened at once. And also, given the conditions outside, you couldn't just send a crew out to go work on it today. You have to consider their safety and, in terms of their ability to get there safely and work safely in those conditions. But, things like that happen every year, maybe not to the extreme level that we saw, but every year usually in the summer. Some of these other winter locations, things, happen in the winter as well. But you'll get a good few days of outlier price behavior every given year. And it doesn't take a lot of hours or days at thousands of dollars to make up a lot of what's normally a $20, $30 market. And just other examples, the lead time on nickel and copper mines, the electric vehicles, the batteries now are, I believe, eight parts copper, 8 parts nickel and 1 part something. So like they're majority nickel now. And, that's just kind of a big surprise, this new generation of car batteries, and when you think about the lead time needed to generate the nickel that's going to be demanded. And then when you look at something like silver, there are very few mines that actually just focus on silver. Silver is typically found with copper, it's found with gold. If it's found with gold, the money that they make off the gold is way more than the money they make off the silver. So they're going to make mining decisions based on the price of gold, not the price of silver. Again, silver is a component in solar cells also. So that's kind of a new source of demand that you can't just say, oh, prices are going up, I'm going to go mine some more. Well, did the price of gold go up? That's really what is going to determine whether someone mines more silver. And then again, you get these instant binary events. The election was kind of an instant binary event for the green movement. Disasters like Fukushima was that nuclear plant in Japan. There was an earthquake, tsunami, caused a big problem. And for a while there, Japan shut down, and Japan uses a lot of nuclear power. They shut down all their nukes while some international agency was doing a report. Took them like a year or two to do the report. And in that meantime, they ramped up their need for LNG. And of course, 2 years later, the report comes out and it basically says, don't build a nuclear power plant on a fault line, where, on the ocean. So they're back to nuclear now. So, I mean, these are kind of, they would seem commonsensical, but you know how the world is. It's a very CYA, everyone be safe, everyone be green, everyone ESG. So they have to go through these motions, which are largely inefficient at times. And there's been several times where we've had earthquakes in Chile, and Chile is a large copper supplier. So you'll kind of see a huge gap up. I believe it was over a weekend once where that happened. And I remember there was a huge gap up on Monday morning for copper. And then back in the day, back when I used to trade natural gas up to like 2008 or so, before a lot of the supply was shale supply onshore, they would have to shut down a whole lot of wells that were in the Gulf of Mexico when a hurricane was coming, because you couldn't have the people on there, just other considerations. So all of a sudden your supply would shrink and prices would jump. For prices that would normally be $3-ish could jump to $8-10 just for a hurricane. And again, with natural gas, if you're freezing in your house, nothing else is really going to do. If your furnace burns natural gas, you're going to pay what it takes to get your natural gas. Here's a example. I just pulled this off the web, where creating asymmetry through longer holding periods in the stock market. If you look at 1 year, it looks fairly normal. You kind of got minus 70 on this tail, plus 70 on this tail. But all of a sudden, if you increase your holding period and look at a 10-year period, you still have this little tail here of negative 70, but all of a sudden your right tail is going out to about 370. And this is just 10 years. If you imagine 20 or 30 years, tail would probably, this whole thing would move further right. So that's another way to do it. Requires a lot of patience, which I'm not very good with. But just wanted to acknowledge that is another way that people create asymmetry. And creating these specific engineered products. You might have heard in March how, in fact, I remember when he was on TV, like, oh my God, the world is coming to an end. That is something I would say if I did not. He was criticized heavily for the way he said things on live TV. People were saying that he was using it to create a panic in which to actually cover his or to buy back his positions in equities. But to make $2.6 billion out of a $27 million bet, that's almost 100 to 1. I mean, that's severe asymmetry. And I believe it was a type of credit product, but it was basically something that he must have gone to his investment bank and said, this is exactly what I want. Break it up into pieces, do whatever you have to do, find other people that want the other side of it. And, and then they would go create that for him. And this other guy, Michael Burry, if you haven't seen the movie Big Short, it's a great movie. Very entertaining way to get an idea of how this all came to be. But he also in that movie went to a bank and had them create a product of very specific CDOs that he wanted. And I kept trying to look for his return, and all I can see is 487% annual return from 2000 to 2008. And I wanted to see what is the 2008 piece of that. I would imagine his returns were fairly normal for a bunch of years.
I got those
You
numbers
do?
starting from the book.
Okay.
It's in the book.
Oh, is it? Okay.
Yeah,
I only
there's
saw
like
the movie.
about five. There's about five of those players that they recorded what they netted on the deal.
Was it a dollar number or a percentage?
Yeah, dollar.
Okay, yeah, dollar number. I think it was like 750 or 650 million or something very large. But yeah, I was trying to figure it out from a
percentage.
Yeah, but yeah.
Well, if you base it off of his premium, then that would be one way to calculate a percentage.
His premium
that he paid for the CDSs.
Okay. Yeah, that's true. That's a good way to approximate.
Anyway, it's a fantastic movie. You guys should really see it if you haven't, and read the book also. It's very interesting.
Yeah, and he's been in the news a little bit lately. He had that GameStop long position, but then more recently he's been tweeting about hyperinflation and kind of some worries he has about that. But again, these become.
Haven't we all been tweeting that for years, Rangan?
Yeah, we have. I've been thinking about it for a long time. This time feels different, which I know is kind of a dirty, the 4 words you don't say, right? This time is different. But just kind of the combination of things like the amount of printing, the amount of debt, the fact that the Fed stopped publishing their M2 numbers or M1, M2 numbers, like they don't want to publish the money supply anymore, like they were every week, I believe.
Wait a minute, they stopped M2 many years ago. They're stopping M1 now.
Oh, okay. Is that what it is? Okay. Yeah, just stopping M1.
Wow.
Modern monetary theory. I mean, who believes that you don't ever have to pay back your debt? You can only just pay the interest on it forever. I don't know how long that can last. Maybe that can last for a long time, but
I thought Keynes taught us that was the best way to go.
Yeah, well, so I think Keynes had a theory of economics that was popular with politicians, and that's why it became popular. And the same thing is going to happen with modern monetary theory. If you tell a politician as much as you want, just make the interest payment, and by the way, we can manipulate the interest rate so that it's going to be low. Politician loves that because they can go buy all the votes that they need. Whereas you have an Austrian, have Hayek or someone tell them that, hey, you got to take your medicine and live through that depression and get rid of those excesses and rebuild on solid footing. No politician is going to want to do that because they have that 4-year term in mind, not the not the 100-year view of the world. But we'll see. What's interesting is he's a smart guy. Obviously, he's made some really good big bets in the past that have paid off. Ray Dalio is another one who. He hasn't come out and said it like that, but he has, his new book that he's publishing a chapter at a time on LinkedIn is all about the changing world order. There's a really good YouTube video, probably about 30 minutes long, where he's put a lot of metrics to each of these empires in the past that were the reserve currency of the world. I believe starting with the Dutch, English, French, I forget the exact order, but he's kind of got this, he looks at technology. Technology leads to a better military leads to protecting trade routes, which allows them to be economically prosperous. And then leading all of that is education. The good education systems lead to the technology, et cetera. And he's kind of found a way to model it all out and just kind of look at the rise and fall of the various empires from the 1500s. And his thesis of all the stuff is kind of the U.S. is sort of in a declining period while China is sort of in a rising period. And he's made comments about gold and getting rid of bonds and just I think cash is trash is his tagline that he gets labeled with a lot. But yeah, who knows? We'll may you live in interesting times, right?
Yes.
So multiple time frame analysis. Now this is where, you know, we have a little bit of control to take a linear market like a futures market and actually have some control to create an asymmetric situation for us. So the stop loss order that you use in trading when you have a liquid efficient market is what creates this asymmetry, because you kind of have that limited amount of loss, in theory limited, yet your the other side of your trade is open. You know, again, the liquidity is what matters, so that's going to depend on the time of day, the relative volume, you know, if there's something crazy going on. Now, in general, when a trend changes, it has to start at the lowest time frame. You know, the first minute you go up, you know, I mean, even the first minute you go up, you're not necessarily in an uptrend, but kind of your 1 minute chart sort of turns into an uptrend before your 5, before your 15, before your 60, before your, you know, daily. And you know, there are times, you know, so obviously that there are points in time where the daily is changing direction. Now the key is if you can catch that on a shorter time frame, then all of a sudden you can establish a trade where your risk is based on that, you know, 5 or 15 minute chart, but your potential reward is kind of based on the daily chart. And there's a lot of different strategies you can do here. I'm just going to go over a couple of them. So now this here is the I would say the worth the price of admission, and something you can look up later. There's a guy named Gann in markets, and he created this method for bar counting, and it's this simple. Basically, a higher high and a higher low is an up bar. A lower high and a lower low is a down bar. A lower high and a higher low is an inside bar. So these are all exclusive, no greater than equal, just greater than or less than. It's an inside bar, and then everything else is an outside bar, because that means it either you know, has a lower low and a higher high, or it has, or one of these is equal, and that would be considered an outside bar. Actually, I'm sorry, I see a mistake in there. It could also be an inside bar, depending, but whatever. Those are both treated the same. So an inside bar and an outside bar takes the label of the previous bar. And markets like to move in 2 wave increments. So if we just look at this, this is a daily chart of natural gas. This would be an up move. This would be a down bar because it's a lower high, lower low. And then this being an inside bar has the same label as that. So it's also a down bar. This is an up bar. This is an up bar. So you kind of had this 1, 2, 3 up. Here you had this boom, 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 down. Then here you have this boom down here. And once this took out that high, right, the assumption is, okay, 1, 2, 3, we're just kind of doing the same thing we've been doing on the daily. And what often happens is as soon as you take out that high, you'll get a pullback to shake people out. And you can view that pullback on a lower time frame. I think this is a 15-minute chart, and following the same logic. So that's kind of your bar that made the high, which is kind of this little poke above. And, you know, down bar, down bar, down bar, down bar, down bar, down bar. This is an outside bar, so it takes the same label. It's a down bar. Now this is an up bar. It has a higher high, higher low. Down bar, down bar. This was inside, so you could also call it a down bar if you'd like. But once you change out of here, you got your 1, 2, 3. You got your kind of 2 waves down pattern, and you can establish a trade here where you're buying on this break above with a stop below. And the beauty of that, and here I just marked 8R, and I tend to take arbitrary exits. You know, I mean, I may look at a chart and be like, oh, there's something over here. I'll, you know, try to get out around there. But over time, it really doesn't matter. What matters is that you had a stop, so you don't have any big left tail events, and that your overall strategy has an edge, so that overall you're making more than you're losing. And then if you look at how that played off, that's actually that 1, 2, 3 was over here, and it kind of sat around for a while, and then the next day it spiked up into here, ended up being 11 times your risk on that trade. And another example is the NASDAQ futures. On this day, you kind of have this down wave, and then as soon as that broke above, you have the change of trend to up. And this is a 5-minute chart. This was that move to up, and down, 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 down. This is an outside bar, down, down, and then this is inside, so it's also down. This is outside, so it's also down. So this is really your first up bar. second up bar, and then you started going down again. This is a down bar, outside, down, inside, down, 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 inside is down. So over here again, you broke out from that 1, 2, 3 move pattern. And that was down here, and you ended up with this very massive move over the next, I think it's about 6 or 8 hours, from down here. So if you're able to catch those turning points on a 5-minute chart, that on a daily chart, I guess I could go back and look, but I would actually think, okay, if you had this move down, then you had an 1, 2, 3 up, 1, 2, I would have probably expected that this may have come back down here, but really all you needed was this move from here to here, based on having such a small amount of risk, that you had a good asymmetric return to that. And going back to the bar counting, the thing that I like so much about that is you can now basically have very simple rules to tell a computer, is this an up bar or a down bar? And so much is controlled by algos these days that this is one of the more subjective ways that people look at markets, but this is kind of a way to make it objective. Typical objective ways are actual prices, volatility, standard deviation, levels, things like that. But looking at an actual bar to bar thing, a lot of people end up having a subjective way of doing it. So I just love the way that this makes it objective. Because when something's objective, you can test it and really see what's working, what's not working, etc. Here's another example. It's a pattern I call the fits, which is it's just a break of a trend line. And this was crude oil before it dipped to zero, where you've had this strong impulse down, then you had this dead cat bounce, and then a bar that was inside. So when that low got taken out, you would know that the daily trend was changing, and that happened overnight. And it happened off of kind of this trend line here, where you have kind of a few touches. So when that were to break down and close down, you could get in around here, and your stop would be right here, which looks like about a 65-cent stop. And by the time pit opened, you were almost $4 lower. So again, the mixing kind of a high time frame with a low time frame, million different ways to do it. Here's just a few of them, but that creates the asymmetry for you. And here's an example from today. This was something I've been watching for a long time, and Tesla has been, after this ugly week down here, 1, 2, 3, 4, 5 whole weeks have been completely inside the range of bar. And so, I started watching it this week, and then all last week, I'm like, okay, is it going to happen? Is it going to happen? And then finally today is when it happened. That number was, I think, 721.11 that I was keeping an eye on. We were up to about 715 in pre-market, which, to me was like, okay, this is close, and, it's possibly going to happen. And, this is a 5-minute chart where on that first 5-minute impulse, it broke right through that level. So, I bought above this with the stop below this. And, I kind of feel like probably clear sailing to about 780 right here, possibly even more. But I tend to want to recycle my capital more rather than hold it and live through a drawdown. But this is just a real of asymmetry. We're looking at a weekly, high time frame. You could take it all the way down to a 5-minute where this broke out. And another little indicator I just looked at here is after that first bar, we were trading about 1.6 times the normal volume over the last 10 days for that first bar. So that's a good sign that it's not a false breakout. There's something behind it. So then that last way that leads into the other little presentation that I had is using options, to create asymmetry. So have you guys studied options? Is that something you guys are familiar with?
They are currently in the middle of a trading competition, which will be closing in a couple of weeks here. So yes, they are familiar with it.
Oh, good. Okay. So you're familiar with that whole limited loss potential, which is just the premium when you're long an option, and in theory you have unlimited upside. So the product itself is structured with asymmetry. So just long option strategies is another way to just create asymmetry in trading. So this was the presentation I had before. It was called positive feedback loops. So every day when you look at the closing options prices, you can look at an at-the-money call and an at-the-money put for kind of the closest option that you have, and that gives you the market's expectation of what the range of that stock should be. People are buying and selling straddles, or individual options, those prices. So they're putting their money where their mouth is. It's not some guy on TV talking about, oh, I think the batteries are going to be better, the Tesla's going to go up. That's his opinion, right? Nobody, and gosh, there's a whole nother rabbit hole that if you really want to go down, it's called deepcapturethemovie.com. And I believe it's on YouTube now. Patrick Byrne, the ex-CEO of Overstock.com, put together a really awesome 45-minute presentation. Basically shows you how the markets are completely rigged.
Wait a minute. Well, what's the name of this movie?
Deep Capture the Movie, all one word. Deepcapturethemovie.com. You might want to be careful randomly searching those terms, but
Gotcha.
but it's and deep capture is the concept of, if you steal $1 from a million different people, nobody's going to care. It's not worth their trouble to come and get it from you. If you steal $1 million from one person, he's going to come looking for you. And he explains the way the incentives and the markets are set up, where it's pretty scary. Just how it's almost like some very large hedge funds are very close with the financial journalists. That, CNBC mentions a certain something at a time when someone needs to get out of something, or they, or vice versa. But yeah, so I like looking at the actual price levels to determine whether or not I think a positive feedback loop is going to develop. And if anything, listening to CNBC or other financial media has more to do with, it's almost more of a contrary indicator to me. And weekly options started trading in 2010, and they grew in popularity. There's over 500 of them now. Maybe about 200 or 300 of them are fairly liquid, but it's plenty of names. And when you think about an option, the shorter the duration of an option, it starts to act more like a binary thing. So if today a stock closes at $50, and let's say the option expires tomorrow, and you have a $50 call or a $50 straddle, your delta is 50, right? Your delta is 50, whatever it would be for being at the money. And all of a sudden tomorrow, if you gap up to 55, your delta is almost 100 if this option is expiring soon, versus if this was a long dated option, okay, your delta is up 55 or 60, it's gone up a little bit. So these options so these weekly options with short duration have that ability to really swing what a hedger would need to do with the underlying stock based on a quick unexpected gap in the price. So when a market is surprised out of balance, it can develop that positive feedback loop. So, imagine if market was $5, a stock was at $50, and the at the money straddle was $5. The market is sort of expecting it to go, be between 45 and 55. And then some news comes out overnight when markets are closed, and the next day you gap up to 60. All of a sudden, anyone that had a straddle on, they had like a neutral delta, all of a sudden they're long, or if they were short the straddle, all of a sudden they're short. So there's kind of a lot of kind of that incremental supply and demand for the stock that comes from the options hedger. You've kind of caught them by surprise, and then the act of them buying to cover their, to hedge their short option position or whatnot would drive the prices further up. And this goes both ways. A positive feedback loop could be to the downside or could be to the upside. It just means there's that reflexivity, that whatever you would call it, that cycle of one thing leading to the next, which leads back to this, which leads back to the next, and you have that cycle that goes on until it stops. So just activity, and Ray Dalio wrote a great book called Principles. And he's actually made little videos on YouTube that are easy to watch. Again, I think I discounted I kind of lived my life thinking everyone must think the way I do. But then I think as I got older, I realized that a lot of people don't. He just kind of lays out how if you create principles for situations in your life, these situations are going to recur, and you have a way of dealing with them rather than just shooting from the hip every time a certain situation happens to you. And, particularly in markets, you want to be objective because it is so easy to want to be right, to want to, to want something, right? I mean, if you really want to believe in hyperinflation, you're going to look at a chart and think that's what's happening, even if the evidence is to the contrary. So, I think there's a guy named Peter Brandt. He has this saying, what does he say? He says, strong opinions like lightly held. So, you have to have conviction in what you're doing, but the opinion itself is lightly held, meaning if some of the information changes, you'll flip your opinion. And this is just something I found very useful. Wikipedia has a list of cognitive biases. There's like dozens of them here, and a lot of them apply to markets. A lot of them apply to other pieces of life, and they were very useful for me. At least back when I was in school, like I don't think these weren't the kind of things that I learned in my classes. I learned more technical, actual things. But something as simple as an anchoring bias, where once a number is out there, someone's mind sticks to it. When you think of an opening price, a price comes out and people start kind of looking at relative value around that opening price, or even in a negotiation, the first number that comes out kind of becomes the anchor around which people go up and down from. So you have to be very careful what that first number that comes out is. There's just a bunch of different biases here. This all goes back to being objective in dealing with markets. So, going back to those boundaries, like in that example where if you have a large options position, the last time that you were able to really put on your delta hedge and balance yourself with ease was at the close. The closing close has a lot of liquidity where you can get very large transactions done. After that, if some news comes out in after hours, the market may or may not be that liquid for you to be able to move the kind of size you need to. So kind of on a normal day, you would not expect a stock to kind of jump out of those ranges. But if there is a large gap, then that leaves one side trapped. And the options delta hedgers, they often can't do what they need to do until the open the next day when liquidity reappears. So, there's a lot of things as a stock to gap. There could be fundamental news, drug approvals, CEOs, went through 4 years of tweets moving the market. Other fundamental changes, things that are happening. These things I put in red, for the most part, I don't believe in I don't trade positive feedback loops that come from these, because just over time, I've realized that they don't work out. And with corporate finance news, I just have my own little theories on it, but maybe it's very easily calculatable that, you did this little financial engineering move, it added X amount of value, boom, it just goes there and it stays. It doesn't tend to just keep going and going and going. And then with that analyst coverage, as it pertains back to that, deep capture, a lot of those are done, they're either known ahead of time and people ride on those coattails and then they exit into the news. So I always look at those more as, hey, is this an honest analyst or not by how the stock actually reacts to their report. So here's an example where an analyst upgrade actually did work. This was Square back in 2018. This analyst came saying that Square should be one of the FANG stocks, the growth potential, et cetera. So the boundary was at the bottom of this yellow box, and it kind of opened here, dipped down a little bit, and then pretty much higher highs the whole way up till the end of the day, and you went from about 88 to 95 after this gap up from 86 to almost 89. And that's just an example of where ahead of time when you're looking at that and that this is that boundary level, your bias is going to be this is probably going to go up, and you can look for whatever pattern you want to get on that. But basically, your bias is this is going higher, and it worked. Another example of Stitch Fix on earnings, the lower boundary was here, it gapped way below the lower boundary, and boom, just bled all day long. And then kind of it seemed like the next day it had a little bit of a balance, but basically, if you're catching a stock, even somewhere up here, it was at 33, $34 with a weekly option expiring in a day or two or four at the most, and then you get a move all the way down to $28, there's 8x potential on those options. In fact, I used to have a very typical exit strategy. I would take half off at 2x, half of the remaining at 4x, and half of the remaining at 8x. And you don't always get the 8x; you just get out at the end of the day. But just having some sort of discipline around that is good. And then typically also, if an option goes down 50% from where I buy it, I'll exit. It's not a liquid enough playing field to just leave your stop out there like you could in futures. So, it may not be 50, it may be 60, it may be 70. Sometimes you lose it all. But typically you're getting these 4 and 8x moves off of risking only half. So this is even double the asymmetry there. Here's another example, and when I get bored, I tweet, but I haven't really done that in a long time. And again, this is well before the open. That Snapchat's upper boundary is 1480, and that's just yesterday's close plus the at the money straddle. And 1480 is this line right here. It gapped up to here, did a little test down, and then boom, all day long, straight up. And then an example from today, Tesla. Now this isn't the type of positive feedback loop that I trade, because I would want to see it gap above that level, or thrust above it very early. And here we kind of just drift, but then we can see that it kind of acted as support once we'd gotten above and came back down. And as I look now, we're actually hitting new highs on it. Or maybe I need to put it up here. Can you see that?
Yeah. Yeah.
And that's Tesla. This was kind of that boundary where it bounced off of, and now we're burning up to new highs again. So just a little quote from Soros that, markets are constantly in a state of flux, and money is made by discounting the obvious and betting on the unexpected. So the obvious is it should stay within that range. The unexpected is breaking through that range, and the more surprising way in which you do it, like a gap straight up, the better the odds of trapping somebody on the other side. So here's an example from 2013, and I remember this vividly. And I remember the prices of 393 and 389. It's, Netflix has split a bunch of times since then, so my charting software doesn't show those numbers. But I remember on this day, we had this up move here, and there was this massive gap from here to here on some tremendous earnings, and all morning long, the CNBC was talking about it. It was wonderful. And I just kept looking at this saying, well, the upper boundary is 393, and, we're not there yet. I mean, sure, this is a great move. I mean, what is that? I guess it'd be hard for me to tell with the splits, but it was a very large gap up. And pretty much as soon as it opened at 389. It was the highest it got. And then boom, it just went straight down. And then somewhere about halfway through the day, there was some news story about Carl Icahn selling half of his stake. But again, it's kind of like the sentiment can lead you astray. That's a big gap up, but you knew that it wasn't really high enough to surprise the options market, which is the people who have their money riding on it are thinking, not just people who are talking. Anyway, which leads me to another book by Nassim Taleb called Skin in the Game. You might have heard it, where you just have to really qualify your information by, does someone have skin in the game, or are they just... So, another example of this, 3M, there was a day where its upper boundary was around 163. And, just before the open, I was just testing, if we can't establish value over that, we're going to fall. And, the next day, so this is another strategy I have where when something's overbought, you tend to want to short the gap up. But, the only exception to that would be if you gap above this upper boundary. And here, the high of the day was 163.08. They kind of made that early push and then failed, and then dropped back $7. So, kind of this is a particular pattern that I call failure to PFL. You have positive feedback loops. So if you look at it from a Venn diagram standpoint, I capture some portion of positive feedback loops that I deem are high quality, meaning higher success rates. And then there's a handful of these situations where I'll actually bet against a feedback loop. I think the conditions are right. And again, being selective is one of the biggest advantages that we have. We don't have to get involved every day. So, and this is where I'll say, you know, art and a little bit of science. When you think about how surprised someone is in a stock that doesn't have good liquidity in the pre-market, you're going to see that move right at the open when the liquidity shows up. In a stock that's extremely liquid, like AMD and Apple come to mind, they're extremely liquid in after hours and before hours. They don't tend to PFL because anyone that's trapped can kind of hedge their positions and get out before the open. So again, the timing of the news, if the news comes out in the morning, people have had less time to react to it versus it came out the night before. They've been able to digest it and do something before the open. Short interest, yeah, I heard you guys had a good presentation on that recently. Stocks that have a high short interest, tend to have that nervous crowd that needs to continue to buy. So those PFLs, that's one of the statistics I look at on a stock that's potentially going to PFL. And then just being extremely overbought or oversold to go with something once it's already extremely overbought and it's continuing to gap higher, or extremely oversold and continuing to gap lower. And I just use a very objective RSI2 above 95 or RSI2 below 5 as my gauge of overbought, oversold. And then the general level of market volatility, when the market itself is in a sell-off, options prices are generally high. So it's, you're kind of overpaying for the option, and it's really hard to get multiples of that price back. So this strategy works better in a bullish market where volatility is low, and then you have, say, an earnings season where you can have a lot of these individual names pop off. Yeah, and then again, extreme market conditions, the same thing, right? I mean, sometimes when things are extremely extreme, just want to stay away. And then, just filters, gapping through a boundary, thrusting through a boundary, the efficiency of the trend. Like when you look at some of these here, this is a very efficient trend. There's a formula for trend efficiency. It's pretty intuitive, but you can just tell it's efficient. It's going up and up and up. It's not doing a lot of this. It's very steady up move. Yeah, just large initial bars show you that imbalance, and then good relative volume show you that the move is more real. So just some final thoughts on this concept of asymmetry. It goes a little bit against human nature, so it takes a little bit of training and prodding in your mind to be okay with it. And here's just a good quote from Jesse Livermore. Trading isn't a daily job where you get daily wages. The desire for constant action, irrespective of underlying conditions, is responsible for many losses in Wall Street, even among the professionals who feel that they must take home some money every day as though they were working for regular wages. And,
Isn't that the truth?
Yep, I've fallen for that too in the past, and depending on where you are in your trading journey, people spend a lot of time focusing on the pattern, the indicator, the entry, the exit, and those things are important, but all of those things can be learned. And just by virtue that you're a graduate student at Rice, you're smart enough to know all that, smart enough to figure it all out. I would tell you the area to focus on is going to be the psychology. That is the part where you battle yourself. I mean, I feel like I've aged a lot because you go through these emotional cycles. I almost feel like I've lived 200 lifetimes, by say someone's eyes that have been, that isn't in the market, because the type of emotions that you go through that you have to learn to control, that you have to learn to fade sometimes, you get to see a lot more of them. Maybe a dentist, who's invested in the stock market, he felt a knot in his stomach in March of last year, and maybe in 2008, and maybe in 2000 he felt a little ecstatic. So over the course of 20 years, he's had really extreme feelings 4 or 5, 8 times. And it's like, I feel like I do that in a week, every week, depending on what you're trading. And the other thing is to embrace one-sided uncertainty, right? Like you'd be surprised how many people out there, they just need the certainty, and they'll give up the right tail for certainty. And, you don't want to take on left tail stuff. A lot of, I'm very precise by nature, and I've always thought about this in the context of my life, where I worked for a small pipeline company that probably at the time I went to work for them, they were probably worth about $100 million. A few years in, they sold a stake at $250 million valuation, and they ended up selling the entire company for $2 billion. And I just remember thinking, these guys, they're nice guys, but they don't have the kind of technical and precision and, like the type of modeling that I was doing, the type of products I was structuring, and they really just kind of came at it with this concept that if you take a small, like an intrastate pipeline, and tie it into an interstate grid, you get certain flexing rights that are worth a ton. And at the end of the day, they're walking away with $2 billion. And sure, they hired me and paid me well for my time there, but it's like being all that precise, sometimes it's just so obvious that something is big and you just got to jump on it, and you may not know how big it is, but you know that the right tail is there. And that's something I've had to kind of learn over time because I'm just a very precise person. And there's just lots of ways to do this. I'm sure you guys will figure out a bunch of ways yourself, and you just have to find one that resonates with you, with your skill and your temperament, because the key is going to be sticking to whatever strategy or plan it is that you devise during your calm times, where you can intellectually think about it and be like, okay, this is the right way to do it. In the middle of a market, like some of these trades that look so simple, at those times, if I could tell you all the thoughts that were going through my head about why this is going to fail, and oh my God, this time it's different. There's this news coming out. There's that. There's a bunch of noise in the heat of the moment, such that you need a strategy that's very well defined and that resonates with you, so you can just stick with it in real time. Yeah. And I guess that's part of where the computer aspect of it helps. But I've never gone to like a completely computerized way of trading. That's just may just be my old so I call my old school nature, but I would never let a computer trade for me. But that is one way that people take the emotion out of it. So that's all I had. You guys have any questions?
Well, first, let's thank Rangan for speaking to us. We really appreciate that. I think that was outstanding. Do we have any questions from you guys? We have a lot of traders in this class, so I'm sure we got tons of questions. Or maybe everyone is so overwhelmed at what a real trader sounds like when they're just sort of thinking out loud that we're just sort of speechless.
That happens to me a lot, usually not in a good way.
Well, I think your public speaking was quite excellent, Rangan. I really do. And what everything you said was about asymmetry, and especially this thing about learning psychology. That's just so critical. You can learn the technical analysis part of it, and you can learn to trade it, but you really should be studying psychology, because everything repeats itself or rhymes, but doesn't repeat itself exactly.
Yep.
Any questions?
Do you have any more examples of like the one-sided uncertainty that you're talking about before, in terms of just like with your job, but also in trading? Are there any?
Like just from life, you mean?
Yeah.
That's a good one. Let's see. Probably about 6 months ago, I made a conscious effort to get out from behind my screens, and that is going to be directly related to that. But I actually made this conscious decision because I kind of realized that there's so many other ways you can make a living in the world other than trading. And, I've been doing this for 20 years, so it kind of feels like this is the only way, but that's my own bias of sitting in front of 8 monitors, all day long. And, I went to La Peep and had breakfast and just took a book and read it and just kind of did stuff like that for a few weeks. And after a couple of weeks, my whole perspective had sort of changed. And there were things that were in my periphery that I never got to focus on because I was so hyper focused on the trading that I started pursuing, and ended up working with a couple of different people now on things that are outside of trading, and they're doing really well. And it's just I had a friend back in the day, actually, this back in 2000, this guy made $7 million from $50,000 between 2000 and 2002, which was actually when the market took a big hit.
Wow.
But he actually made this money going long all of those, JDSUs and Siebel and Extreme Networks, all those high flyers at the time. He basically captured the, he'd really honed in on the art of when that bear market bounce was coming, and just rinse, repeat every one of those bounces. And so the point being, with him, he got out of trading around 2002 or 3, I think. And he was going through kind of the same, oh my God, what do I do? And he's a little older than me. And, he went to go be a consultant at Deloitte, I think, and then later at Pricewaterhouse, and he became a partner. Then he went out and started his own venture capital fund, and now he's doing all of that. But every time I kind of fear leaving my little comfort zone, I talk to him, and his advice is always, trading is one of those things in which you assimilate so much information so fast and become so decisive. You have to be decisive with that information, that skill set can do anything you want. You just have to be patient because the rest of the world moves a lot slower. So that was something that's always, it doesn't always feel that way when you're circulating a resume, but it's true. Every time I've taken on various consulting roles and other kind of things, and you kind of just realize that the world moves at a totally different pace than the market. And if you are so engrossed in the market, your pace has gotten a lot faster. But I guess so in terms of asymmetry, I start looking at like every product, everything offered in the world as kind of an asymmetric option, where, think about a Comcast bundling this product with that product or whatnot, right? It's not a market, but they've looked at it and they've said, wow, when we put A, B, and C together, people actually pay us A plus B plus C plus 10, just because A, B, and C are together. And they have a large customer base, and these days you can run all kinds of data on that. And they create this structured product, which, I'm used to seeing structured products in the market, but you're basically, I guess with big data and whatnot, now you're uncovering all kinds of inefficiencies in human nature, which a lot of them, again, go back to, those cognitive biases. And it's a great book, Predictably Irrational, by Dan Ariely.
Whatever happened to your copy, Rangan?
I think you have it still. It's quite all right. I haven't had the inkling to read that in a while, but it's just, data is so available now to describe these inefficiencies that are just prevalent, and they're just human nature. And maybe in the past it was it's that guy on that advertising show. Gosh, I forgot his name. The guy with the slick hair. I forgot that show, but back then it was like people in advertising knew these things, and that's what made them so valuable and so profitable to the ad firm. Nowadays, it's like you get so much data collected and analyzed, and you can think from that, even if you don't have the intuition that people used to have for that.
Well, guys, we're going to have to cut it off here for today. Rangan, where do we get your book?
My book?
Oh, you don't have a book?
No, I don't have a book.
When are you going to write that book so we can get it on Amazon with you and Linda Bradford Rashke?
Maybe eventually. She just wrote a book recently, and she gave a shout out to me in the prologue or the epilogue. I'm not sure if it's I think it had to do more with my sense of humor. But
I think it had to do with your survival rate. If you survive more than 5 years in this trading business, then you might make it.
Point, and staying with the asymmetry is a good way to survive. Blowing up happens when you do the opposite.
Okay, guys, I'm going to have to run today. Thank you all so much for your attention. Rangan, thank you for participating with us today. And I hope you enjoyed it here, and hopefully you can come back again sometime.
Absolutely.
All righty. Y'all have a good morning.